Good afternoon, ladies and gentlemen. I'm King Au, Executive Director of the FSDC. Thank you for joining the second webinar of our FSDC Industry Exchange Series. We seek to broaden our engagement and encourage dialogue with the financial services industry on topics of strategic importance through this webinar series. Our Make an Impact discussion topic today is very timely, as COVID-19 pandemic has wreaked havoc around the world. Our four distinguished speakers are going to share their views with us on how the investment community can help make the world better through investments that generate positive, measurable social and environmental impacts with good financial returns at the same time. So let me briefly introduce Mr. Joseph Chan, JP Undersecretary for Financial Services and the Treasury of the Hong Kong SAR Government, Ms. Ronnie Mack, Managing Director from RS Group, Mr. Mo Saifury Monet, Senior Advisor for Southeast Asia Global Impact Investing Network. Joining from Australia is Mr. Michael Salfatico, Head of Asia Pacific ESG Business Development, S&P Global Market Intelligence. There will be a Q&A session after the discussion. The audience can type their question in the chat box on the Zoom system, and I'll direct them to our speakers accordingly. So let me start the discussion first with Joseph. Joseph, the Hong Kong government has been very proactive in supporting the development of ESG as well as green and sustainable finance in recent years. We are very pleased to see much traction by the markets too. Can you please highlight the key initiatives that the Hong Kong government and regulators have undertaken, as well as the rationale behind them?
Sure. King, thank you very much for offering me this opportunity to join you all today. Let me first walk through the rationale or the background about sustainable finance from the view of the government of the Hong Kong SAR, and then I'll walk through a few key initiatives that we have launched over the last couple of years. So, well, as a backdrop, Hong Kong is the international financial center of Asia, as indeed we lead the league tables in the region across IPO funds raised, across asset and wealth management business by AUM, and the insurance business as well. We are also the largest offshore renminbi center in the world. Thus, we are very well positioned to be the leading regional hub for green and sustainable finance. At the moment, we serve as a premier financing platform for international and mainland green enterprises and projects in raising funds through issuing bonds, through IPOs, and other channels such as fund distribution and syndicated loans. Our core strengths, including free flow of capital, a sound legal and regulatory system, deep and liquid capital markets, and robust financial infrastructure, help maximize Hong Kong's potentials in developing ESG and sustainable finance. China is the second largest country of green bond issuance, while over 80% of their green bonds were issued onshore over the last few years. That presents a huge opportunity to Hong Kong to help Chinese issuers for issuing offshore green bonds, especially those in offshore renminbi. The outline development plan for the Guangdong, Hong Kong, Macau Greater Bay Area GBA promulgated last year supports Hong Kong's development into a green finance center in the region. And then the opinion on providing financial support for the development of the GBA announced in May this year also supports more GBA entities to make use of Hong Kong's platform for the financing and certification of their green projects. On the other hand, under the Belt and Road Initiative, we will also promote Hong Kong's platform by supporting Chinese enterprises to raise funds through green projects in the region. Well, ESG and sustainable finance is indeed one of the current administration's key policy priorities, and we have rolled out a series of measures to support such market development, including the Green Bond Certification Scheme, which covers not only green bonds, but also green funds and ESG funds, the Green Bond Grant Scheme, which subsidizes certification of green bonds, and of course, one key initiative is the Government Green Bond Program, under which we issued our inaugural government green bond successfully with 4 times oversubscription last year. and we plan to issue green bonds totaling 66 billion Hong Kong dollars under this government program in the 5 years from the year of 2020 to 21, as announced in the budget earlier this year. On the other hand, our regulators have also rolled out a wide range of sustainable finance initiatives, including the HKEX Sustainable and Green Exchange stage, launched by the HKEX earlier this month, the white paper on green and sustainable banking published by the HKMA in June this year, as well as the consultation launched by the SFC in October this year on proposed requirements for fund managers to take climate-related risks into consideration in their investment and risk management processes, and also to make appropriate disclosures to meet investors' growing demands for climate risk information and combat greenwashing. Well, as a wide range of policy initiatives have been launched by the government and different regulators, we have established the Green and Sustainable Finance Cross-Agency Steering Group in May. This steering group aims to coordinate the management of climate and environmental risks to the financial sector and accelerate the growth of green and sustainable finance in Hong Kong. It will provide strategic direction with a focus on regulatory policy and market development, and facilitates regional cooperation, including the Greater Bay Area. So, King, as you hear, is a wide range of initiatives that we have rolled out, and the government and the regulators are very committed in the journey of ESG and sustainable finance. I'll stop here and I'll take another round of questions later. Thank you.
Thanks so much, Joseph. That's very encouraging. Maud, let me turn to you now, because you are the expert. I think we all agree that Europe is quite ahead of the rest of the world when it comes to green and sustainable investment, ranging from awareness to standard, taxonomy, and even market size. But today's topic, impact investment, is relatively new development. Can you please tell us a bit more about what it really means, and also the evolution of the size of this impact investment market, especially in terms of Apac, how it is positioned globally?
Sure, absolutely. And thank you for inviting me to this discussion. And let me actually demonstrate you that it's not that new, given that it has already more than a decade. And maybe if we take a step back, what is really at the core of impact investing? It's really to look at a world where financial markets and investors will play a role in solving our biggest social and environmental challenges. And of course, there is climate, you mentioned it, but there are also other challenges that are highlighted by the Sustainable Development Goals. And very importantly, it's an investment that generates positive impact, but also financial return. And that's a very important point. And if I can say a word of the GIN, the Global Impact Investing Network, it's a vision that is actually driven by our members. And our members are institutional asset owners, pension funds, insurance companies, foundations, but also family offices, and also asset managers. And of course, you may wonder how it relates to ESG or sustainable investing. And if I'm really short about it, there are 4 characteristics. Of course, intention, right? You must have an intention to contribute to positive and environmental solutions. You must include impact in your investment strategy, and you must be also able to measure and manage the impact results. That's probably the core characteristic of impact. And now, if you would like, I'd like to share a couple of slides just to highlight a bit that it's actually not that new. It's actually a market which is already very developed. So let me do it right now. Do you see my slide? Okay. And actually the first slide gives actually a highlight of what you should keep in mind, right? And it's taken from the GIN annual survey. It's our 10th edition, so 10 years already of impact investment, demonstrating that the market is already quite evolved and sophisticated and still growing very fast at 17% per year. So it's not that young, it's not that pioneer anymore. It's a size of $700 billion USD. So still a significant supply of capital to solve the most pressing issues. And if you look at the slides, there are 2 very important findings. The first one, It's not philanthropy. Actually, 7 out of 10 impact investors are looking for risk-adjusted market returns. And please, it's a very important thing to remember. It's an investment opportunity. And the second part, most of the organizations actually that focus on impact, it's only part of their investment strategy, right? It coexists with other investment strategy, and that's also important to remember. Next slide, actually, it's very diverse. And when I say very diverse, again, it's not about philanthropy. When you look at the survey, the vast majority of organizations who have answers are actually asset managers, that's on the right side, who are looking for for-profit opportunities, and also pension funds and insurance company and DA5 and foundations. And what motivates them, that's also very important. I mean, obviously, it's impact investing, it's a mission. It's central to any impact investment decision, but very important, and you see it at the middle, they believe, 70% actually believe that impact investment are financially attractive compared to other investment. And that's also a very important finding. And now at this stage, you are probably wondering, okay, but what is attractive? And that's again taken from our survey. And you see, of course, a variety of return depending on the asset class. But you can see that it's very decent. And it's investment contributing to solve economic and social issues. Now coming to APAC, it's a very attractive market, and it has actually grown a lot, and there are many investment opportunities. It's roughly 25% of the global asset under management globally invested in impact. And in 2020, we saw as well a fast growth of 23% per annum. So it's really an invitation for any investors to look at this opportunity. That's the sectors that are commonly looked at: energy, financial services, food and agriculture, etc. And maybe the last point, and I stop here, when we did our survey, we looked at, of course, the geographical spread, and still Asia-based impact investor, and I include actually APAC, represent only 13% of the GIN respondents. And I guess it's a good proxy of the market share. While if you remember, 25% of the assets under management go to Asia. So it also, of course, brings the question, right? And we see a lot of momentum, and I'm sure Ronnie will also explain us the role that RS Group plays and SFI plays among family offices. We see a lot of traction, but there is still investors to be mobilized in this space. And of course, it will be a question that I hope we will be discussing today, right? How to capture this business opportunity and how to integrate also impact investing as a hub activity for Hong Kong.
That's great. It's very informative. Actually, it's very interesting to see that it confirms a lot of our understanding that the momentum, that the trend is really driven by investors. And now this is very timely. We have Ronnie on our panel because she's a great speaker, and also her profession overlaps two of our very key research topics. That's namely family office focusing on sustainability. As an investor, as we just heard from Maud, it's really driving this global trend. So, can you share with us what you think of Hong Kong in terms of our competitiveness as a financial hub for financing sustainable projects, and also our opportunities for us in impact investing?
Yeah, sure. Thank you. Thank you, Dr. King, and thank you to FSDC for inviting me to share with this distinguished panel today. So thank you for the kind words and asking this really important question. To RS Group, so just quickly, RS Group is a family office with a mission. We're based here in Hong Kong. We carry out our mission by the way we manage and deploy our capital, which is 100% sustainably invested across our asset classes. So to us, I think this question about whether Hong Kong should and can be a leading sustainable finance center has been with us for a very long time. And this is back to when our group started our journey back in 2008. That's almost 12 years ago. And the reason why it's such an important question is actually three different reasons. One is out of the need, second is out of fear, and third is out of desire. So first of all, when I say out of need is as a family office, obviously when we start on this journey, the first thing we think about is we need to find the right products. We need to find the right advisory capabilities, whether it's from banks and financial institutions and advisors. So naturally, the first thing as a family office we do is go to our banks and say, oh, what can you do? We want to start our impact journey. And unfortunately, back then at the time, there wasn't as a sophisticated understanding of what ESG impact and sustainability was. And so I think at most we were offered a water fund, here and there. And so what happened then was, in order to get what we wanted, we had to go all the way to Europe to find our independent investment advisor and also the product suite that we were looking at. So this brings me to the second point, which is fear, because what we did and what we fear is that if Hong Kong cannot provide the kind of products and services, then naturally when investors want that, they will go outside of Hong Kong, which means there'll be a capital outflow. And so that we understood. And so by 2015, we were already successfully 100% sustainably invested across all of our asset classes. But that also meant that most of our investments were based in the US and in Europe. And by about 2016, we started to really kind of explore again this desire, I think this of Hong Kong having more products so we can shift this capital back and invest into at least Hong Kong or regionally based products. And at that time was when we did an RFP of a discretionary ESG discretionary mandate in Hong Kong to I think we sent it to, it must have been we screened over 20 banks in Hong Kong at that time. And at the end, we evaluated around 6 proposals. These are for ESG discretionary mandates. And at the end, we chose 2. And the reason we did this quite intentionally in Hong Kong, where we could have sent these discretionary mandates to US and Europe, where we did most of our investments, was we wanted to kind of show the banks in Hong Kong that there is investor demand for these type of services. And then also when we talk to the banks about why there isn't more products and services, is often the chicken egg, oh, we don't see the client demand. But then within our peer group of investors, it's like, oh, we don't see the products either. So constantly kind of stuck in that kind of conundrum. And so we wanted to break that. And so we wanted to show the banks that there is demand, there's money on the table, and that we wanted to help Hong Kong banks to build a track record as well. And at that time, we were told by all of the banks that we were the first Asian-based investor to come to them to ask for such a discretionary mandate. But since then, there has been more. And so that's kind of hopefully helped. And so the third point about the desire is really wanting to Hong Kong develop and seeing the potential, to your question, is Hong Kong is the leading IFC. But then once you put the sustainability lens on it, this was back then, there was a lot of gaps. And so I think we felt so strongly about this that we developed the Sustainable Finance Initiative back in 2016. We launched this in 2018. I think Mo just mentioned this. And what this is a platform mainly of private investors coming together to learn and to meet each other, as well as to co-invest into sustainable and deals, sustainable and ESG impact kind of deals. Where we are now is we've grown to almost like 20 active investors, and then more on the side that's looking to join this group. And part of this is really trying to affect the ecosystem of policy regulations where we would co-sign, and we develop and co-sign signatures into government consultations, Hong Kong EX, Hong Kong MA, SFC, whatever you have it, we would submit. And so you would understand how happy and thrilled we are over the developments that we've seen in Hong Kong the last 2 years, which is more than I think the last 10 years combined. I think Joseph listed out really this distinctly all those developments, whether it's Hong Kong's the regulators, it's the government. So we're really happy to see this accelerated development. But I think the last point I want to say is that we must keep this up and we must continue to move fast, because a lot of competitors in the region, like Singapore, are also moving very fast. And so we would just like to see Hong Kong maintain this, and investors, we will be here to support that development.
Thank you so much, Ronnie. I think really have to thank you and RS Group on behalf of the industry for being a pioneer in such a great movement on sustainability. So thanks so much again. Now, Michael, you are really a regional expert on this. Wearing an Apac hat. So although you're based in Australia, so I want to hear from you. How you have been advising your clients in the region or the Australian government, on sustainability and impact investing. And we would love to learn from you.
Thank you, Dr. King, and it is a great pleasure to be here and participate in this panel with these great speakers. In terms of Asia Pac and ESG investing and the impact investing journey, I think of three things. I think firstly that we're in a pivotal point in the history of finance, and that's kind of come out in the other speakers' presentations. The other thing that I think is measure, report, and manage, and that's kind of because of the area that I've been focused on in my history of working in finance from a sell-side research perspective, and then over the last 10 years in the ESG space directly in Asia Pac. And the third is seize the opportunities, and that's really what we're talking about today, the opportunities that we have within Asia Pacific. I thought just to add a little bit of context quickly, Dr. King, on why I'm with S&P, because most people might think about S&P as an index provider or a credit ratings provider. That's really our position leadership in the world. But we also have a large pool of data and analytics that sits in the market intelligence team where I am, and research on commodities and energy. And so that's the specializations come through adopting True Cost as one of the leading providers of climate research and research on SDGs, EU taxonomy and alignment. So that's really the viewpoint that I come from, and I've been in this role with S&P for 6 months. It's been a great journey. Like I say, I feel we're at a pivotal point in the history of finance, and by that I mean the importance of climate change impacts and the broader environmental and social issues on sustainability. They're upon us. And this is a good thing, because Asia Pac is exposed to those goals that the SDGs represent, given our largely developing status and our geographical location. And the good news is that within Asia Pac, we've seen a rapid rise in the adoption of ESG in recent years, compared to the 10 years that I've been specifically focused on sustainability. And parts of Asia Pac have been really quick adopters of ESG, and we can measure it in multiple ways. I mean, one of those ways is the country investor and company activity and commitments to ESG and climate risk, such as the commitments to net zero. And in Australia, while we haven't seen the same commitments from our government, we've seen enormous commitments from the investors. It's almost made up for the lack of direction and targets, you could say. I certainly say that from personal observation, coming from a federal perspective. And we see that in the adoption of the UNPRI, in activities such as the AIGCC, the Asia Investor Group on Climate Change, and the local CIFs. But also we've seen activity in Asia Pac from exchanges, regulators. We've seen stewardship codes come up in the last 5 years. So really active investor activity. And this is important, because the next step of the ESG journey is to accept that we understand better the risks, and that the companies are aware of these risks, they're being engaged on them, but look at the output, look at the opportunities that are coming to investors through frameworks such as the SDGs. And if you look at the SDGs, when we're analysing the SDGs, if you think about the opportunity set, one thing I'm sure that Maud would confirm is that it represents the capacity to unlock $12 trillion globally and add 380 million jobs a year by 2030. And so at S&P, we're very excited by this area of finance that has been picked up. I think the maturity of the finance sector has seen the opportunity. We've seen that with the EU taxonomy. So we spend a lot of time analysing the revenue breakdown of companies and their alignment to those activities in the EU taxonomy. We're looking at over 15,000 companies and their revenue alignment to that data set. So this enables investors to do that measurement. Same with the SDGs. This is something that we're very focused on, and it's opening up that ability for investors to I suppose to avoid the greenwashing by having a third party analyze and measure subjectively what they say they're doing. So these are some of the things that we see. One of the other things that I really want to bring out is a few of the initiatives around Asia Pac were mentioned. I had the great fortune to be involved in the Australia Sustainable Financial Initiative. We've just launched the 37 recommendations, and Dr. King, I highly recommend you and the audience have a look at this, because it really is providing a framework for the rest of Asia Pac and globally to think about. It was sort of taken from the high-level expert group concept that came out of Europe and Canada. So these things are happening around the world. But that idea of embedding sustainability in leadership, integrating sustainability into practice, enabling resilience, right, for Australians, building sustainable financial markets. These are the things that S&P Global Market Intelligence look at, and we work with clients to achieve these recommendations, whether that's establishing targets and trajectories to support net zero, or support sustainable development and impact and resilience of markets.
Yeah, thanks so much. You brought up quite a few important issues such as data, talent, measure, report, and manage. These are three very important steps. That actually brings me back to Joseph, because Michael just highlighted the opportunities as well as challenges, and also how we can adopt these global standards to our local economies, fitting into our local environment. So on that, Joseph, you probably the reason why we've been making so much progress is because you came from the market, so you have a very close connection with the market. So what have you heard from investors and services providers these days about the appetite, the challenges and opportunities when it comes to impact investing and sustainability?
Well, thank you very much, King. Thank you. And I have to say that for all the panels that I have attended before, this is the first time that I'm asked about sustainable finance with the end goal from my previous life as a practitioner, a history that I'm very proud of, having been part of the industry. So thanks a lot for bringing this up. If I may first talk about what I heard from the market, more from a commercial angle. Beforehand, I would say, actually, right before I joined the government, I was working in an investment bank, which was actually a leading player in Asia on distributing green bonds. And back then, I was responsible for the Asia global market business, including the sales of green bonds to institutional investors in the region. So I can claim that I actually have firsthand experience how the green bond transactions were marketed and executed. Because back then, as an industry practitioner, seeing the green bond transactions, client interest, and the volume or so, I already believed that green finance and sustainable finance was the next big thing for the global markets business. Well, going back to what I've heard from the market recently, to begin with, a lot of issuers told me that by issuing green bonds instead of traditional bonds, their potential investor base would actually grow by 40%, 40%, or even more. This is due to the fact that many institutional investors nowadays, especially those from Europe, have mandate to invest in green instruments only for part of or the entire portfolio. So while the notional, these additional investors may not represent the majority of the allocation today, it is important to the issuers to broaden their potential investor base, not only for today, for the current issuance, but also for future issuance as well. And when we talk about commercial benefits, and I think echoing what Mo mentioned just now, of course, the funding cost is another important consideration to the market. According to a report by the Hong Kong Academy of Finance issued last month, green bonds reduce a firm's cost of borrowing for issuers. The cost advantage is very prominent, actually by close to 50 basis points when the green bond is verified or certified by an external party. And issuers of green bond also benefit from the equity markets as well. On issuance of green bonds, the share price of the firms typically reacts with an upward jump when a green bond was received independent verification or certification. And that possibly reflects the importance of transparency to investors. And also for investors, there was accumulating evidence suggesting that ESG investment, including green bonds, may outperform their non-ESG counterparts and better weather adverse situations. So for instance, during the COVID-19 epidemic, green bonds have been found to provide a better risk-return trade-off when compared to conventional bonds. So these are more the commercial elements I've heard from the market. And of course, in terms of the ongoing development, at the moment, there are multiple standards that issuers have to follow, such as for Europe, then certain standards are more widely accepted. And then for the onshore renminbi green bond by Chinese issuers, then the standard accepted by the local regulators are more important to them. So at the moment, a lot of issuers have to apply for certification or validation for multiple green standards or green bond standards, including to meet the requirement of investors from different regions per se. So they're all looking for a more unified taxonomy globally. And of course, as a lot of you have heard, I think globally regulators are working towards that goal as well. Thank you.
Yes, it's a challenging task, trying to come up with a global standard. But definitely it is something we should all try. On that note, actually, I want to come back to you, Michael, because you mentioned about SDG right earlier, and you have been advising both private and public sectors on ESG. Right, for quite some time. So I want to ask you two questions, actually. The first one is, so how does SDG framework actually can be applied to companies in APAC? Because APAC has a very diverse economies. Some are more developed, some are still catching up. And the other part of my question is, how do companies report on SDGs, and how should investors align their investment with the SDG goals? A lot there, Michael.
Yeah, there is a lot. Yeah, we've got an hour.
I'm greedy.
Yeah, because definitely, when I'm hearing this, I'm thinking about it through the lens of analyzing companies, and it's the analysis of companies, the way we think about them. I'll say there, just in case there's any compliance on the call, we don't advise or consult companies. We provide analysis on companies, on the companies themselves, and on the for investors too. And we're shifting away from what was just being talked about, which is the green bonds area, and that's so interesting too. So we do analysis of green bonds, and our S&P Global Ratings actually do green bond evaluation. So we're right in the thick of the green bonds area as well. But on the company side, I want to make a statement that's clear. SDGs can be applied to all investments and all companies, both listed and unlisted, both large and small in scale. And Maud might be sitting there wondering, hang on a sec, well, how does, you might have heard the listed story before, but let's talk through it, because the S&P approach assesses companies' alignment to the SDGs as well as measuring additionality, and that's through listed markets. Let's talk about what it is, what's in scope and what's out of scope, as well as understanding the exposure risk, so the negative alignment. And we do this we do this for 15,000 companies, or we will by the end of this year, and we'll get to that number. The approach wasn't designed by ourselves either. When you think about who does it apply to and how does it apply, we went out and we spoke to an advisory panel, including, the likes of PGGM, who are well thought of in the space of impact investing, Calvert, Impacts, and we spoke to the UN Global Compact as well. I'm not sure, Maud, whether you were involved in those discussions, but maybe, I think, because you've got some involvement there, as well as companies, like HP, Badola, AMD, and Rockwool were involved in this thinking, in this logic, and that is, assessing the share of SDG aligned revenues by mapping a company's revenue by product category to our assessments of their positive impact. Okay, and that's looking really deeply at the bottom-up analysis of the 169 SDG targets. We stood back and we looked and we said, right, what is it that we want to do? How are we going to do it? And what do we need to do it? So we started with the framework of the SDGs, and I think that really shows in the detail that we go into. So, if we're looking at sanitation, service, and products, which align to SDG 6, we're measuring toilet preparation manufacturing. So, as one of the many examples that we look at. On the additionality side, again, it applies to companies. We're looking at the companies, where they operate, what they do, their products and their services, and where they go. And we're saying, well, it's some investments that a company makes in products have a greater contribution they're more additional in what they provide and how they meet the goals of the SDGs. And an example like that would be, a sanitation service products, which would contribute more in India to additionality than in the United States. Or for instance, if you're putting a solar panel farm in China, it would have greater additionality given the mix of energy compared to if you put it into Europe. So, that's another way that we're measuring SDGs through listed companies' investments. And the third one, which is really important, is, to be aware of exposure risk. So, or misalignment, or do no harm. That concept also is important to us. So again, when we think about companies, we're not just thinking about their operations, their direct suppliers, but their indirect suppliers as well. So we're looking throughout the different tiers of the company's involvement and their suppliers, and we're measuring the risks that they're exposed to, and that might be a child labor risk, in the direct operations or value chain. It might be a labor rights risk, and so we're thinking about it through that lens. And finally, on that point, just that reporting and disclosure. It's one of those key points that I said. Measure, report, and manage. Transparency can lead to greater efficiency in our assessments and in capital allocation. And if companies aren't reporting on SDGs or ESGs, then their metrics are going to be modelled. So I tell investors as well as companies, to start that process, to go out, have a proper measurement, get proper analysis done so that you can report internally first. We're not saying that everything has to be external straight away, and identify what it is you report externally.
Yeah, you're right. Transparency is very important, especially to investors. So that's why I think Hong Kong EX has, mandated that listed company must report on ESG. Now I want to go back to the investor perspective, both Ronnie and Mo. But let me start with Ronnie first, because there's a saying that green and sustainable investment is almost just like CSR, corporate social responsibility. It's really doing it, for common, community good. It's not for return. Is this something you look at as, you consider that true, or you really think you can combine both sustainability with return? Share with us your experience, Ronnie.
Yeah, sure. Definitely. I think being an active, sustainable impact investor for so long, we definitely say yes. In fact, we say yes so much that in the earlier parts of our journey, as I mentioned earlier, where we try to build up a 100% sustainably invested portfolio. The reason for doing that was to demonstrate or use our portfolio to demonstrate to our peers, other private investors, families, foundations, that you can invest to achieve the returns that you want. But also be able to achieve the social and environmental impacts. And so we actually published our first impact report back in 2016 that showcases this journey that we went on, and most importantly, showcasing our portfolio. So we basically, apart from the numbers, we disclose everything, including who we invest in, our asset allocation, who are our partners, not just on the investment side, but also on the philanthropy side. The whole point was about being able to do good and do well, and the message was to endowments and foundations that please don't just invest that 5% return that you gain from your investments and put it in the philanthropy bucket, where that rest of that 95% is sitting there, maybe just trying to maximize return but having absolutely no impact. The idea is that you can utilize and invest that 95% for impact, as well as to generate the returns that you need. So definitely yes, and I think using again our own investment portfolio, in the report we've demonstrated then that we could achieve market-based return. Again, we have the benchmark for that initial 5-6 years, but even protracting onwards up to now, it's been almost an over 10 year. We still maintain that kind of performance to be able to achieve overall around net 5%, but that's net of our cost, and that's allowing us to make all the philanthropy and grants. And there's been years that there's up and down, but overall I think it's really achieved at market returns. And I think Joseph pointed out a point about COVID as well. We've realized that in our performance over the last 12 years, it has indeed weathered a lot of storms, whether it's the oil crisis or previous market crashes. We've always been quite resilient. And with COVID, I think whether it's through our own portfolio or through the 2 discretionary bank mandates that I mentioned earlier, has definitely outperformed the market. With the 2 mandates easily around 3%, so 300 basis points. So that's quite a lot in the first quarter. And we also understood at that time from Morningstar that they had a peak in the amount of investments that's going into ESG. So definitely, I think overall, to answer your question, definitely, and I think that message is very important as well to investors, that you can invest for the returns that you desire, as well as to achieve the impact that you need, and that there's a lot of different products that you can look at across that capital spectrum. It's just a matter of will you find time and patience to look for the right products for that right risk-adjusted return level.
That's a very impressive track record, Ronnie just mentioned. We'd love to get our hands on the report you mentioned. Is that publicly available?
Yes, it's publicly available. We actually have a whole website. If you go to our
great. Excellent. Thanks. So we'll definitely go and look it up and study it in more detail. There's so much to learn from that, from your experience. Now, Mo, because talking about investment, you're an expert. You've been doing this for decades. But I want to drill down to the sector level. Are there sectors that are more conducive to impact investing, or do they change over time?
Yes, thank you. Yeah, look, I like also to give my own perspective, right? And Joseph gave his own background, mostly working with listed bonds, and my perspective actually comes from the private space. Because I have worked mostly, maybe not decades, but a decade, it's already enough, in impact investing. With one of the leaders in the sector, and I was regional director. So my background was mostly in financial inclusion and climate finance in the context of private debt. And I can safely say that when we started 12 years ago, it was really with a modest portfolio and modest footprint, and we ended up with almost $1 billion invested in private debt and private equity in companies delivering impact. And Ronnie said at the beginning that it's about needs and desire. So let me come back to the needs and desire of impact and the needs, right? Most of the impact investment, it's actually consistent with the Sustainable Development Goal, goes to emerging economies. Not all, but a big part. And that's actually the core of my own experience, right? During all these years, I've done maybe more than 100 due diligence on the field. And I have seen what it means to belong to, let's say, to poor and rural communities, right? If you belong to these communities, it means you have no or you have less access to a bank account. It means you have no or less access to fertilizer for your crops. You have no or less access to quality education, to formal employment, and particularly during COVID and climate change. So of course, it's a tragedy. There is a tragedy of poverty, but it also creates opportunities. And that's opportunities because companies, and Michael said it before, right, with this example in India, because company can actually provide access to basic products and services for low-income population. And in return, it creates investment opportunities for investors. And when I look back at my own experience, in the microfinance space, in the financial service space, which is still one of the first asset class in impact investment, it has definitely demonstrated a combination of return, financial return, but also positive impact for development. If I reflect on our portfolio, we started financing small institution, microcredit, sometimes NGO and BFI, that over time became regulated entities, sometimes banking institution. And as a result, when you look at the financial inclusion today in Southeast Asia, it has been an explosive progress. Now, coming to where are the opportunities for investors today? Financial services, for sure, is still a large sector. And today, it's not so much about microfinance, even still it's there. It's about fintechs, and fintechs trying to reach the missing segment of the population, women and SMEs in countries like Indonesia or the Philippines or Vietnam in the region. Certainly a sector where Hong Kong is well placed to play a role. Energy, clean energy, access to clean energy. And today we see really many business models being tested on the ground, ranging from financial institution trying to develop green lending products to companies providing small rooftops, for example, for individuals or school or hospital. So it's a business opportunity. It has also a huge impact, of course, on climate, but also on health and education. And we see new topics such as healthcare, particularly in the context of COVID. Food and agriculture, which needs additional investment to strengthen the value chain. Water, access to clean water. And actually, there is currently an initiative going on in the region by Danone and Incofin with one of our members to provide clean water to population in emerging countries. And so all these sectors provide definitely investment opportunities. And I would say what brings technology as it has emerged as a critical conduit for basic services across sector. And Hong Kong is well positioned actually to invest in those sectors. And coming to my point, and it was alluded as well by Ronnie, you asked about the challenges, right? There are opportunities. Hong Kong and financial places in Apac in general are well placed to take part of it. Joseph has mentioned already a number of initiatives taken by the Hong Kong government, right? There is infrastructure, there is the joint group, there is, of course, the traditional role of Hong Kong as international and regional finance center. I would add there is also the internationalization of Hong Kong, right? Today, I see, players like AXA or UBS or Prudential, all members of the GIN today, all having an experience in impact investing, and just a sample, there are many more, along with local players, and they can bring an experience in impact investing. So it's really about building up an ecosystem, engaging with a variety of stakeholders. I think Michael alluded to that for Australia, right? It's really building the foundation, right, together of the ecosystem. And also maybe look at regulatory opportunities to encourage prudent investment, but also remove barriers that may happen to really foster investment that both seek impact and return. And maybe one last word, if you would allow. as we are looking at Australia, because Michael invited us to look at it, I think there are also a couple of international examples that could be interesting to look at. I'm thinking of Switzerland, simply because, well, I used to work for a Swiss company, but also because Switzerland has similarities with Hong Kong as a financial place. And it has really emerged as a big place for impact investment, with fund manager actually capturing a big chunk of the asset management in impact investment. So there is certainly interesting, experience to look at and bring to Hong Kong. And closer to us, there is also Japan, as a matter of fact, who has done a huge work and is really mobilized towards impact investment. One of our members, for example, and I'll stop here, SIF, has become a fund distribution organization to distribute dormant deposits and channel them to impact. So again, another example. And one more point, and Ronnie said it as well, education. We see there's still misconception, right? One of the topics today was the trade-off between impact and return. We have to debunk all this misconception, and how to change the mindset. It's actually a complex question. I would say it starts also with education. And look, today I see in Hong Kong a lot of things moving, right? To give you an example, I just discussing with the CFA Hong Kong. They are very eager to work with us on a webinar on impact investing. That's great. I know Hong Kong UST is also looking at designing specific programs at a bachelor level to integrate sustainability, green finance, and impact. And that's really great. And that's how Hong Kong can play his role among other financial places as impact investing hub.
Yes, I think we all need to work together on it. As we've been saying, it's a very major movement globally. But maybe I'll go back to Ronnie, because we talked about impact investing, right? We talked about return, but how can we measure the success of impact? Because they may vary from project to project. So can you share your experience with us?
Yeah, that's a very important and big question. And I think, as Mo sort of alluded to, the whole impact measurement space has really developed a lot over the last few years. And is often what we call an alphabet soup now. So you have a lot of different standards, anything from GRI to SASB to TCFD to carbon CDP, and then you have SDG, I think that Michael talked about. And so it's a mixed bag. And I think for investors, though, I think if I try to answer a bit more, what we are seeing within our community is an increasing adoption from not just investors, but also asset managers, so the fund managers that we invest in, into a standard called the IMP framework, which is the impact measurement product. And it is a tool that is used, I think, mainly originate from Bridges Ventures in Europe and the US. And it's a sort of a consensus that they're trying to build that tries to align with the different kind of standards. So that's something that's more increasingly used based on the few key questions of who, what, how, what the kind of impact risk that you're looking at. So it's a pretty broad kind of framework that's becoming popular. I think the other point I'll point out is that for us as a family office, the difference is we invest on a portfolio basis rather than just looking at an individual fund or individual company. We want to assess the impact across all of our asset classes. So anything from listed equity funds, listed debt, to private equity, to direct investments, to real assets, real estate. And so being able to find a metric that we can use to kind of consolidate the impact across the portfolio has been a holy grail, I think, for us. So I think I talked about the report that we launched. And so for us, the way we talked about impact there was we had to do it by asset classes. So for example, for the listed equities, we talked about ESG, we talked about carbon footprint, and this was back in 2016. Obviously now I think there's a lot more tools that we can use. And then on the private equity side, we use Iris. So I think the point there is now there's a lot more interest, but yet also a lot more confusion with the different standards and how they relate to each other. And so I think what I want to point out, last point, is that there's a very important recent development, which I'm sure a lot of you may be aware of, is the IFRS, so the financial reporting standards setting organization that sets all the accounting reporting standards globally. So they launched a consultation in September to basically assess the appetite from the international community about setting up a global sustainable reporting standards and the role that IFRS can play. So this is really important because at the end, of the day, I think as investors and stakeholders, whether it's the product developers, the banks, everyone is seeking a more standardized and common framework. And so we think back to accounting standards that took 100 years to develop. So I think if IFRS is willing to take this on, and they're working with SASB to do this as well, then and to have it sort of under the IFRS framework, the 3-tier governance framework of governance and decision making and reporting. So that's a really important development, and that's something that we are working with other investors to put a submission and to add our views and support. And so that development, I think, would take time, but if it happens, I think that would be really important to really, from the taxonomy perspective, for the sector to take off.
Yeah, thanks so much, Ronnie. That's a very important piece of information. So, Michael, I want to quickly come back to you. Sustainable and green finance definitely a key research topic for us at the FSDC. But how can we raise the priority of SDG investing to the same status as, say, climate risk? Because everyone talks about carbon neutral, but I guess SDG is broader than that. So any advice from you, please, Michael?
Yes, yeah. Thanks, Dr. King. Look, I think when I think about how can we do that, and I spend a lot of time working with investors across Asia Pac, especially Australia, and I think it's timing. I think we're at that point where there's a wave of impact investing in front of us, and I do believe that because I see things like the frameworks, the scalability, the appetite of investors, the maturity of financial markets, and of course, the performance of SDG strategies. So if I just dig a little bit deeper into each one of those, the frameworks such as SDGs, they've been around now for 5 years. People understand them. They're starting to understand how they can apply to companies, how companies can actually achieve positive outcomes. We've got an appetite from investors, as social expectations shift towards profit with purpose, not just profit at all costs. And the reports that we see indicate, we're on the edge of the largest generational transfer of wealth in the history of millennials. So they place strong value on purpose, impact, and sustainability of a company, and companies recognize that. Scalability, looking at the SDGs through the lens of listed companies provides scalability and liquidity, and these two are the things that investors value. And I don't mean to say that doesn't mean that smaller investments, such as the ones that Maud were talking about, if they are smaller in size, they're just as important. There's a space for both of these things, right? We want the whole world working towards these improvements in social and environmental outcomes. The maturity of markets, and by that I mean we see the markets rising, financial markets rising with the products. We talk a lot about green bonds, and we talk a lot about the analysis of data and measuring the ESGs, measuring the SDGs, measuring the EU taxonomy alignment, green revenue share. These are all things that we do and can do for companies and investors. And finally, we recently released some research on SDG strategies and EU taxonomy strategies, and they showed outperformance, and a good amount of outperformance depending on your perspective and view. So if you look at constructing an SDG aligned portfolio with the S&P 500 or a world developed market index, you see positive active return over the period from 2014 of 10.4% for the S&P 500, 12.7% for the MSCI World Index. And if you're looking at it through a green revenue lens, we see that equities with higher exposure to green revenues outperform those with lower exposure, and that's quintile analysis, by 2.62% on average annually. And that analysis was from 2010. So we're seeing all this evidence, and all this evidence is being put in front of investors. So to answer your question, we continue to demonstrate the positive outcomes socially and environmentally, and the outcomes from a performance perspective. And just to throw in there, I'm a bit of an economics nut, and I've been watching Stephanie Kelton talk about the modern monetary theory and how governments can spend money if they're a sovereign capital fund for good purpose without necessarily a negative income. Now, I've probably just created a massive diversion in the way people are thinking, but what I'm saying is there's all of these signals which are pointing towards this wave of impact investing in front of us.
Thank you, Michael. Before we draw the panel to a close, I have to ask Joseph this very last, but I think important question on ESG-related talent availability in Hong Kong. Please share with us what the government's been thinking on this important topic.
Sure, King, thank you. Well, of course, financial services industry by itself is a people's business. And in terms of ESG-related talents, of course, it's very important as well. If we look at the tertiary education level, the moment among the local universities, the University of Hong Kong and the Hong Kong University of Science and Technology, they offer green finance and impact investing courses, and the ESG investing courses as well to the students as well. In terms of professional training, various institutions, including the Hong Kong Securities and Investment Institute, the Hong Kong Institute of Bankers, and the HKQAA also offer a wide range of courses on ESG-related subject matters. In fact, some of these courses are actually eligible for the financial incentive scheme of the government's pilot program to enhance talent training for the asset and wealth management business. So basically, the applicants could actually get subsidized for taking these courses. On the other hand, we are also stepping up our publicity efforts and investor education to raise the awareness and enhance the knowledge in green and sustainable finance, which would be conducive to its long-term development. And as Mo mentioned, or echoing what she said, the internalization is also very important, and we recognize that. So with a view to raising investor awareness of green finance and related matters, the Investor and Financial Education Council, which is a subsidiary of the SFC, has held seminars on ESG and sustainable investing, as well as has launched a dedicated website with articles and videos to introduce and promote green finance to the general public through mass media and social media platforms. On the other hand, the MPFA, the Mandatory Property Fund Authority of Hong Kong, has also issued a circular to encourage trustees and funds to disclose their approach to ESG factors in the investment policies. And as we all know, the MPF is basically the pension fund scheme, the mandatory pension fund scheme of Hong Kong. So that will impact the major public as well. So we recognize talent is important, and also raising the public's awareness of ESG is important. And the government will continue to launch different initiatives to step up our effort in these aspects. Thank you.
Thank you, Joseph. It's very encouraging to hear that all these positive initiatives coming out from the government. I think it takes a public-private sector partnership to really promote impact investing, ESG, and climate awareness. But we have quite a few questions. I know we've overrun a little bit, but let me try and gather some of these questions together. I have one for Ronnie. That is, a lot of private investors are getting together to co-invest in impact investments. Can you comment on the trend and whether such trend will reduce the attractiveness or incentive for banks and asset managers to, develop their own portfolios or funds for, general investors?
Sure. Thank you. Thank you, King, and thank you for raising whoever raised this question. Yeah, I think in terms of this incentive, I think it's actually the opposite. So maybe I'll clarify when I meant that the Sustainable Finance Initiative platform that we have, where we have our community of investors co-investing, that means that they will get together to look at deals together, whether they're funds or direct investments. And then if there's one or two lead investors, then the others will kind of almost like a syndication, will ride on the due diligence and the leadership of these anchor investors to then make their own investments. So if anything, I think these kind of activities, we do it because we want to increase the investor demand by facilitating exposure to these investors of more what we think are good impact deals. And then through, say, if RS Group anchors some of the deals, again, through leadership, in hoping to bring in a lot of other investors who often, especially the ones that are earlier on the journey, they often want to have a follower kind of mentality, that they want to follow these investors that they trust and they know what they can do, and also leverage on their resources and team. So I think it increases the investor demand, which then shows the funds and the banks that there is that demand, giving them that case to then tell them, hey, you need to come up with more products, and which their investors looking at. So that was the whole point of doing it. So I think it's the other way around. I think it's designed to kind of spur more demand to then trigger the kind of product supply to come.
Thanks. We've got quite a lot of questions coming in. So we've got one for Michael. Is the rising competition to become green and sustainable investment centers, what are the key strengths of Hong Kong as compared to other competitors in the region?
I think Joseph talked very well to those key strengths. It's initiatives like the stock exchange focusing on a green version of their listings. It's the finance, the appetite from the finance services to provide the channels for green investing. Look, Joseph, I think this sort of comes back to you in terms of all the points that you mentioned at the beginning of the presentation. I mean, I was writing down lists from all the great initiatives that you had there. So, you know, really that was that summed up to me that Hong Kong is serious about green finance and investing.
Great, and with the endorsement from Michael. So on that note, Joseph, you know, there's this related question. So what do you see as the potential challenges in developing educational programs on ESG related topics?
Sure, King, thank you. Well, of course, I think for Hong Kong, we face certain challenges in terms of developing education for ESG related talents. It's the same challenges, I suppose, the rest of the world. It's the fact that ESG is still, in the financial world, is still a relatively a new topic. Of course, they've been here for a long time, but it's still evolving, meaning that in terms of standards, methodology, they keep changing and evolving. So there's no real one single textbook or Bible that can tell you everything about ESG that you can use for the next 10 years. Since because of the dynamic and evolving nature, when we design these education programs, especially those professional training as well, like King, what you mentioned earlier on, we really need the public-private partnership to work together, because there's always actually the market practitioners, be that the financial institutions, the rating agencies, or so. They have the latest information about what the investors are looking for. They know the latest development in terms of methodologies or so. And of course, our regulators will play a role as well to share from a regulation perspective, the global regulator community perspective, what they're looking for, or what are the latest rules and guidelines or circulars issued. So it's a very dynamic subject in terms of ESG. And that's why when we design the education programs, we really have to move fast to make sure that whoever attending these courses get the latest information.
Thanks. I've got a question for Mo. The question is, what lessons can we learn from the green and sustainable investments in Europe? What kind of challenges have they encountered, and what can Hong Kong learn from them?
Mm-hmm. No, it's a great question. I would say generally Europe and also the US have been leading the pack, right, when it comes to impact investment. Michael mentioned earlier on the role of PGGM, right? Actually, PGGM, it's a very large Dutch pension fund. I think they have probably in the 200 billion USD asset size. And that's one of these big institutional investors who have been playing a very important role in impact investing. Actually, they have joined recently the GIN, so that's also why I'm mentioning them. So I think in Europe, more than challenges, I would say it's actually a strong drive from the investor side and large pension funds, large insurance company, large financial institution to actually drive the move and supported by regulatory framework that we know very well. So now, example for Hong Kong, I think it has been said by Joseph and also by Michael, Hong Kong has really what it needs, right, to become one of these hub of impact investment. It's really about now putting it high at the agenda and bringing together all the different stakeholders.
Yeah. Oh, sorry. I have got one more question, but I've seemed to have lost my screen. Hang on. Yes. Okay. I'll try to combine quite a few questions together. It's a question really for all our external experts, for Ronnie, Maud, and Michael. That's to help make investment decisions. So what kind of quantitative and qualitative ESG data or tools should investors look at, to determine whether the investment target is ESG aligned or the level of impact this investment may make? So basically, how you make your decision. Yeah.
I mean, if I can have a quick go at that first. I mean, what's important is that you start with an assessment that's standardized across the companies you're looking at, that allows you then to have a comparable assessment for your investments to other investments or to benchmarks. So it's important to benchmark your performance as an investor. There's guidelines and frameworks to reporting, whether that's a TCFD guideline on the types of metrics that you should be including around risk, such as your carbon intensity. There's analysis for ESG assessments, which can be aggregated up to a portfolio level and allow you to compare your ESG exposures. And same with SDGs. I mean, using the SDG framework, which is relevant for this panel, that you can use the SDGs as your framework, right down to 169 goals to measure the products and services that companies are providing, and the alignment of those products and services to the SDGs, and compare that. And there are organisations that are doing this. So there are investors that are reporting on their alignment to SDGs, and again, it's efforts, these small efforts that start off that grow bigger, and investors are looking to analyse their managers through that lens, as well as the lens of exposure and performance.
Yeah, thanks.
Maybe if I can jump to this question, because actually Ronnie was kind enough to mention IRIS, and IRIS Plus, it's a tool that has been developed by the GIN actually for many years. And it helps actually investors to understand their impact, but also to incorporate impact consideration in decision making. And in essence, it's a tool that is publicly available, so you can check on the website, create your own profile, and navigate through it. It's a widely recognized methodology. Most of impact investors actually use it. And it's aligned also with more than 50 standards and framework. I think it was discussed somehow fragmentation somehow in this space. So there is a really conscious effort. And maybe if I go to the next level, right now, of course, there is a set of metrics, and you can align your portfolio with SDGs using IRIS+. But the goal ultimately is to move a step forward and creating a methodology to really compare, gather data and compare, so that you know if you have been successful as an impact investor, also in comparisons to sectors. And just to mention, in terms of tools, we have just recently published 2 reports, one on sustainable agriculture and one on financial services, available on the website, really going in this direction.
Great, thanks. Ronnie, as a practitioner.
Yeah, sure. And maybe I can just quickly add in interest of time. I think my answer is it depends on what asset class that you're looking at, and sometimes what thematic areas as well that you choose. So for example, if you're looking at listed equity stocks, then obviously there are the like MSCIs, there's the Sustainalytics, there's the True Cost, which is now part of S&P, that does these company-wide ESG kind of profiles, and obviously there's Morningstar as well. And we see our fund managers using a combination of these that feeds into their own internal ESG kind of scoring system. And then I think I mentioned thematic as well. So for example, climate is a big thing for us, climate change, where we strengthened our climate lens. And so we were thinking about doing a climate scenario analysis and product sensitivity analysis. And for that, then you're using different type of providers, again, True Cost leaders in that, and also ISS as well, and Mercer and a few others. So I guess what I'm saying is right now, because there's no one universal standard, you kind of look at different tools for different asset classes, the different themes that you're looking at. And obviously private equity, you can use the IMP framework, the impact management project framework that I mentioned. So yeah.
Great. Yeah, I'm afraid I have to bring this interesting and engaging panel to a close. So thank you so much to all of you for sharing your insightful comments with all the audience. And I also want to thank everyone for joining this webinar. But last and not the least, I want to thank the 16 organizations supporting our webinar. Their names and logos are on our website. So thanks again, everyone, for joining us today. I hope you enjoyed the discussion as much as I do. So thank you. But the video will be recorded and available on our website. Thanks, everyone.
Thank you.
Bye.
Cheers.
Bye. Thank you.
Thank you.